This is the only silver and gold video you need to watch in August. For those who are new, I am Jordan Royburn and I earned the Chartered Market Technician and Master of Financial Technical Analysis designations. And in this video, I'm going to go over technicals and sentiment first and then get to fundamentals more deeply. So, getting to the technicals, starting off the week here, another good day for gold and silver. A good start to the week. You can see the white candles here. Gold was up 1% on the day. Silver was up 3.5 cents to nearly 60 skas. But back to gold first. I neglected to mention this in my last video, but there is a small bullish bottoming pattern in both gold and silver. You can see the inverse head and shoulders here. Shoulder here, shoulder here. Here's the head, neckline here. Same thing in silver. So this projects conservatively to about 4,400. We are almost there. The close today was 43.90. Now, we noted in the past video 4,400 resistance. You do have the 200-day moving average here at 44.83. So that's going to be a magnet. And also, when we look more closely at the price action, we can see there was a peak here. We can see there was a top here and also a top here. This is where the final impulsive decline really began. You can see here. So from this level here, again, top there, top here, and also it was a low here, some resistance here, almost a low here. So you can sense this is a real key level. So we're looking at 4,500 right here. So 4,500, the 200 days at 4,480. Gold pushing up nicely. No sign of weakness, 43.90. So look for gold to make it up to 4,500. And if gold were to continue to show strength, even at 4,500, I would look at 4,800. So 4,500 to 4,800 here. So this is 4,800 here. That would probably be the area where gold strength would slow down. Now, down to silver, $70 is going to be a magnet because you can see this line here. It was a key level here, key level here, key support on this rebound. It was key resistance, was also resistance before this grinding rally. And then you have the 200-day moving average right at 70. So silver closed just below 66. This mini head and shoulders projects up to 68. So silver should continue up to 70. Gold to 4,500. Beyond that, for silver, it would encounter a lot more resistance in the mid-70s. Now, moving on, let's take a look at how gold is performing against the various other markets and asset classes. This is something I have not done in quite a while, but I charted this all the time in the past because it's important to evaluate how gold is performing against the other markets. We don't want it to be a situation where gold is just going up because it's an all-market bubble and everything's going up, or the dollar is crashing and gold is only going up because of that. So anyway, how is gold performing against other markets and asset classes? Well, this chart here is a look at gold against the foreign currency. So this is looking at gold against all the other currencies. It's removing the dollar from the equation. And you can see here, very nice bottom here, where it spent really almost 2 months tracing out this bottom. Gold against the stock market here. You can see you had this double bottom here. This was somewhat of a false breakdown here, very tiny false breakdown, but now it's back above the bottoming formation. Gold against bonds here, very strong. We know bonds have been really weak. So good to see this. So when we look at gold's performance here, we like the bottom that's been put in, and then you look at gold against the other markets and asset classes, it looks pretty good. So gold in real terms doing pretty well. We'll continue to monitor that as gold approaches 4,500 and perhaps even a little bit higher after that. Now, another reason that gold has made a bottom is because of sentiment. We've talked about this quite a bit in past videos, but I just wanted to highlight this one more time. The Bank of America Fund Manager Survey. And so Bank of America, every month they survey global hedge fund managers. So this is big money. These are the investors, the hedge funds that really, really matter. And so if you see these lines up here, it means the fund managers basically think gold's overvalued. Below this line, they think it's undervalued. So last month, and by the way, we should get this data very soon. So I have my eyes out for the updated chart. But keep in mind, in the last month, this was the lowest reading in 3+ years. And you go back to when gold was in a secular bull market. And this data here, this was basically the lowest reading other than the depths of the financial crisis in October 2008. So when one considers these sentiment readings and then you look at the price action, I really don't know how you can make an argument that we haven't seen the bottom in gold and gold stocks as well, and silver too. Now, before I get to fundamentals, just one more technical chart, and I showed this in my Friday weekly market recap, and I've updated this. So the Friday weekly market recap, I was looking at the gains in gold stocks for a single week. Now in this chart, I'm just looking at the last 7 days. So these show the gains over rolling 7-day periods. And so I have marked similar gains to the last 7 days, and these vertical lines show similar periods. Now the red are points where it was bearish and the blue bullish for the market. So if we look at the market in the current context where this rally occurred after a steep decline, this is a 40% decline, and you look at similar points, you can see right here a late 2022 bottom, the COVID crash low here. This was at the end of 2016, and then you have here late 2008. So if you're not at a blow-off move like you were here, or in a market crash like you were in the middle of 2008, or even down here in 2013, it's then always bullish for gold stocks. And so point blank, what it really tells us is that this low is going to hold. This low is in for gold stocks. Now, as an analyst, it's important to consider everything and not just technicals and sentiment in history. You also have to look at and assess fundamentals. And so what are the fundamentals that are driving this move? Well, it comes down to two things. We see significant buying from China, and this has happened at all the important market bottoms in the last 5 years, including 2018. And secondly, the market is no longer discounting tighter Fed policy. The market can sense that the Fed is doing a small form of yield curve control right now with respect to printing money to help stave off the decline in the Japanese yen. And in addition, the market can sense that the Fed really doesn't want to hike rates, and that the increase in bond yields that we've seen across the curve has actually done the Fed's job of tightening to a large degree. Now, for more color and expertise on all these matters, I bring in my friend Vince Lansansi of GoldFix. Do we have a bottom this month? What is driving everything right now? To get the answers, Vince Lansansi, publisher and editor of GoldFix on Substack. He's also an adjunct professor at the University of Connecticut, teaching corporate finance. So Vince, been several months since we've done this, at least for me and my money. We do have a bottom in precious metals, but there's still plenty of skepticism out there. So tossing this over to you, I know there's several charts we're going to get into later, talking about the key themes right now, but first and foremost, how do you see things in the market right now? Well, the reasons that the market is going up are the reasons that the market has bottomed. So I'll give you an example, and we're going to touch on most of these. I think there has been much central bank buying in the 4,000 area. A big part of that has been China, which we'll discuss. That's the first thing. So that's why we bottomed. That's not to say they could have gotten filled and we could have gotten lower, but as the market was hovering in that area, Fed policy is perceived to be changing. The war is perceived to be ending. Whether it's good or bad, how it ends is entirely remains to be seen. And all those things seem to be good for gold and silver. And specifically because the new Fed chairwash people were worried that he was going to be very hawkish. And if he's very hawkish, he'd raise rates. And if he raised rates, that would be putting a kibosh on any gold rally. And it might have cracked the market under 4,000. So those are all the reasons when you read what the banks are putting out now for the market to be rallying, and those are the same reasons for the market to be bottoming. So the rally is the bottom, but I mean that's my opening salvo. I mean, what do you think? Well, I know we'll get into this later. I think the technical evidence is very strong, and I agree with you. And by the way, just a side point for people out there, we're always looking at technicals and fundamentals, like you have to look everything. One of my beefs with technical analysts is they only want to look at the chart and just draw trend lines and look at price action. And so there's a lot of other stuff out there that you can mix in that can support your point or debunk your point or make you change your mind. So that's why I love talking to you and having you on, because you're following all these developments. But one thing I would say, 2 points, and the second one is kind of a follow-up. I guess they both can be follow-ups, but the first thing I would say is the fundamental negative factors for gold. They all seem to be temporary. There was an expiration date. The war is going on. Oil is going to go up. Interest rates are going up. They're bombing. That's bad. worse is going to hike because of that. And then worse is going to hike the market. The market's going to be tough on the Fed. Those things, there's an expiration date. They weren't permanent. To me, they were temporary factors. Then the second thing, it's so interesting, and I know you can speak on this, like all the research and things you're looking at, the headlines day to day. 2 weeks ago, they were like all bearish, and suddenly you have this big move in precious metals, and days later, everything that's coming out is, oh, well, we're rallying cold. It's in a powerful uptrend. It's resuming. It's just, to me, it's just hilarious how everything is so reactionary market. That's true. To the second point you made, I would say that that's a coming of age for us, that we're actually getting into an environment where gold is no longer a permit bear market. So now people are actually saying, oh, maybe I should change my mind a little bit faster this time. So we've wiped out all the permit bears. They're done. They're done. You made a point that the temper, the fundamental factor, the bearish factors being temporarily negative. Let me interrupt before I lose my train of thought. Yeah, go ahead. You made a comment about fundamentals versus technicals, or fundamentals complementing technicals. I think you really do yourself a disservice if you're completely fundamental or completely technical. The best macro traders that I know are fundamentalists who use technicals to trigger their entries and exits. Right? So, and that's how I model myself. I try to be like that. I'm not saying that I am like that. The best technicians I know, when they have a level on a breakout, you being one of them, when they have a level on a breakout or an inflection point or something that says that the market should go, they'll check in with me and say, is there anything in the news right now? And I'll say, yes, this is in the news, potentially bullish. And then they'll say, okay, great, that confirms, that confirms. Or it's always, there is a term in measuring risk or in measuring things in general called consilience. And that term says that the best measures of risk are measures of risk that are done from different points of view. So if I'm fundamental and I'm bullish, and you're technical and you're bullish, then that adds up to more than the sum of the parts, because it's different disciplines. When you can approach a problem using different disciplines, it's better than approaching a problem using one discipline and measuring it over and over again. The analogy is, you have a piece of wood and someone tells you to measure it and you say it's 6 inches. It's 6 inches. But if the tape measure is broken, then it might not be 6 inches. You don't know if the tape measure is accurate. So you need another form of measurement, and that will be to measure it with someone else's tape measure. And someone else's tape measure, in my case, would be fundamental. So it's always good to have a variety of styles to measure risk, and in our case, potential reward with that. So that's, yeah, I mean, your comment about that is, this has been greatly helpful for me as well when we do these. And in fact, I'm here sitting with you talking about, these are the reasons that the bottom is in, and you're agreeing or adding to it. But then if you pull up a chart, which you had shown me last week, and we pull it up? I have it handy. Yeah, we can get to that. Yeah, if you'd like. Yeah, let's do that now. Where is it? Opinions aside, well, there you have it. I mean, that chart tells you a lot about if we're in a bottom or not. And this is one of your charts sent out, and it shows the analog of previous post-major breakout corrections, and labeled there is 1973, 2006, 2008, and 2026 in the dark black line. And you can see that the analog is measuring pretty well. I'll leave you to explain the chart, your chart. Right. So gold in its history has had 3 major breakouts. There's not a fourth. It's clear there's 3, and there's really only 3. And then if you want to look at breakouts aside from that, they're much weaker, much less significant. So you have these 3 breakouts. So I'm looking at when was the first big correction after the breakout and the big move. So 70, 73, 2006, and 2026. Now, I added 2008 at the end as we were getting to the end of this correction, before we knew that, or at least had a strong opinion that a bottom was in. Because as you can see, 2008 in terms of time and price, it's a little bit worse than the current correction in 1973. Those are extremely close together. The circles show where they all bottomed. So You can see that, and if you're looking at the significant corrections during secular bull markets in gold, so you think 1970 to 1980, 2001, 2011, in present, the worst correction, which is an outlier, was 75 to 76, that 45% decline over 20 months. I've talked about that in past videos, why we weren't going to duplicate that, even though people were automatically mentioning that several months ago. So if you put that aside, then this is the four biggest corrections, aside from that granddaddy of corrections within a secular bull, corrections that are not a major top. So aside from that one, these are basically the four biggest corrections, and they align really closely. The fifth one would be different, but I'm sorry, go ahead. Oh, but just basically in time. And even if you look at the fifth and the sixth one, like time and price, they're all very similar. Like they're around 5 months to 7 months, and they're 20% to 30% basically. And so if you look at these, the four biggest ones which stand alone, you can look at the circles. These are pretty damn close to each other. The current correction, the thick black in 1973. I mean, that's been the last 2 years. That move was very similar to what we had in 72, 73. So the market has been tracking that very closely. And if you look at the current bottom, if that was actually, I think, the only day we closed below 4,000 in spot. But if you go to the left and you can look at, that's the bottom at 73, the other circle there, which is just to the right there, and look at the current correction. The current correction almost bottomed right there, like literally a day, but a day or two before, right at the same point. So it's amazing to me how similar this has been to the 73 correction. And in recent weeks, or even in days, I've been mentioning, well, if we didn't bottom, if we're not bottoming now, then we're probably going to see one last move lower, and that would align very closely with the 2008 bottom that you can see there. So then you have the 2006 bottom, which was very similar, a little bit less mild than these corrections, but they all line up really, really well. And so this just all makes the point that historically this is something that we should have expected, a correction like this. I did start showing this earlier in the year, I want to say March or April, but you don't know, and you don't know if it's going to play out, because I did have a similar chart where we were correcting at points last year, and then that abated really quickly and the market remained redot. But yeah, what has played out is not a surprise, because markets, they rhyme over time, and they're in with these analog charts. I'm trying to compare points that are extremely similar. I'm not just pulling comparisons out of, where I'm looking at, okay, when did the market break out? When did it have this peak? When is it correct? How much should it correct? So looking for that makes it, I think, doing that work and research before you make the chart. And that raises the chance that they could line up with this and that the outcome can be so similar. Okay. So my conclusion from looking at this, just the way you just described it, as these two being within a stone's throw of each other, if people who can't see the scale of this is February of 26 to October of 26. So this is days, and this is not really a big deal. I would say that if by chance this little rally here was aborted and we came down and made another low around here, it's interesting that it's not much lower than the previous low. And it's also interesting that it happens in September, which is right before buy season starts for gold. I don't make too big of a thing of it, but seasonality still does matter. I have a question about the other bull market correction that people were comparing it to, that you said no. Why did you disagree, or why did you say no? Well, 75 to 76, if you compare the current move to the one in the early 70s, right? Basically what happened is that market, you had this 29% decline in 73, and then you can see that, like, that move rocketed back up. I think that was in the heat of stagflation in 73. So that move rocketed back up really quickly. The market, I think, doubled literally in 3 or 4 months, and then it had a brief 20% correction. Then it went up to its final peak around 200 then. But if you look at that move, that was a move in, I think, like 4 years or less than 4 years, from 35 to 200. So that was a really sharp and fast move. But here's the biggest thing, and you have to look at intermarket analysis, which is really important, and that's when you're comparing all markets together. And so when you look at intermarket analysis, Vince, that peak in 75 1975, gold against the S&P in the preceding 4 years was up like 700%. So in real terms, the move was even stronger than in nominal terms. And why was that? Well, that was when you had a 50% or 45% decline in the S&P with the heat of stag, the 73 to 74, the market was cut in half. And so much capital was moving out of stocks at that point and into gold. And so when you got to that peak, the market was down 50%. Everything was bombed out. Gold was off the charts. This 6x move basically in 4 years. And so there was room for not only like a 20 or 30% correction, but there was room for something even bigger because the stock market was so oversold that gold was going to correct. And so money was going to come out of gold and go into the stock market. And so we don't have that setup now. It's a different setup where, like the late 60s, we've had everything doing well except bonds. Bonds are in a secular bear. Money's been moving out of bonds. It's been going into stocks, been going into gold at the same time. So the setup is much different. You don't have that extreme overbought in real terms for gold. Gold is not overbought in real terms. It's quite the opposite, actually. So I think we could, I'm just guessing, it's just a guess, it doesn't mean anything, but maybe in 3 years we could get to that point where we have that 75 to 76 sharp downturn in gold. But people have to understand the big declines in gold. If you look at the secular peaks in 80, 2011, and that wasn't a secular peak, but we can include 75, 76 in there. Those were huge declines because you had so much money moving out of gold and going into the stock market at the time. They were accompanied by commensurate increases in stocks, right? And the issue now is that stocks are not valued or they're not undervalued or underbought relative to gold like they were in 1975, 2011, 1980. We're not coming out of a stagflationary era. We may be going into one. And so that's your comment about exactly. Yeah. That's why I mentioned maybe in 2 or 3 years, if we're at the end of the decade and gold's at 9,000 and silver's at 200 and they're off the charts and the stock market's down 40%, then you would say, okay, this looks a lot like the mid-70s where you could get that really sharp drawdown, but we don't have anything like that. And also, if as far as pure price action, if that were going to play out, what you would need to see happen, which would be a little similar, is basically gold would flatline here around 4,000 basically into next year, and then you'd have some big move down. That's basically how it played out, right? But fundamentally, I don't know if you could really make a case for that. Okay, cool. Right, so I mean that's the bottom line. The bottom line is the analogies which you created to be a guide to see if history would in fact rhyme or not have turned out to be very reliable for these particularly relevant analogies. I'm using the word twice, 1973, 2006 and 2008. 2008 is still remains to be seen, but that's down here, over here. But it's only 2 months away from this low here in the black line to 2008's low. It's only 2 months, so it's actually less than 2 months. So that's a good point, because if you actually zoom out or did this with a weekly chart, and like if we were to zoom out and look at a 5-year analog or something like that, they would all look really, really close. Right. The differences would go away because you're zooming out a little bit. What about this chart here? Okay. Well, sorry, did I go too soon?
Well, the last point I was going to make in regards to 2008, the 01208 move in gold. So that was corrected 30% 2008. It was actually similar to the 2018 low to the 2026 move that we just had. So if gold were to continue lower for a couple more months, I mean, I think the odds of that are very low now. But if that were to happen, it could make sense given that the 01208 move in terms of duration and percentage gain was very similar to the 18 to 26 move. Right. And that's one you'll draw up if we start to turn down, you'll pull up that 18 to 26 move. Yeah, I mean, both the gains were like over 300% in both cases, and the timing was somewhat similar. So that's the link. That's the link, historically, the 2008 move. But yeah, we can move on. Okay, so explain this chart to me. Let me make it bigger. What is this chart? Okay, so you can also do this with GDX, but I chose the Huey because before we had GDX and GDXJ in the mid-2000s, this was the go-to gold stock index in the early 2000s, but down at the bottom we're just
looking at the 1 week rate of change. What is the 1 week performance of gold stocks? And so I'm looking at what were the other periods where we had like a 15% or 20% up move. And I remember I actually looked at this in 2025, because in the middle of 2025 or early, we did have a huge move there, which was actually, yeah, right. There was actually part of a breakout move. So I remember looking at that and realizing this is actually bullish. This is not bearish when you have this huge move higher. So looking at the history of this, Vince, we can see that, like, let's look at the context. So the context is this has just happened after a 40% decline in the gold stocks, right? Now, if you look at the beginning of the chart, some of those moves were actually at the end of a move. So the very beginning, you have the year one that was an interim peak there. You had it in '02. So basically blow off. That's the word I was looking for. So if this move comes in a blow off, it's definitely bearish. And you can see in the early 2000s, it came in a blow off. However, we noted 2025, which you circled earlier, and then also 2003. Like, you could circle that one in 2003. That was similar to 2025. Those were breakout moves. So those were in the middle of breakout moves. You mean this one here? Yeah, you can see that was a breakout move. So the blue dotted lines, yes, it's all the blue dotted. Okay, but so we looked at the ones that were in the middle of a breakout, or the ones that were blow off. That's the wrong context. The right context is basically after a steep decline in the sector. So you can look at 2000, you could look at 2008, 2020, 2016, and now those declines were steeper. Gold stocks were probably more oversold then. But what did they all tell us? They all were bullish and signaled that you don't fade the knee-jerk rally after a decline. Right. And there's one caveat that I do want to mention. In the middle of 2015, there is one there, that thick line. Yes. So this would be the worst case with the current context, where the market came, it was still bottoming, like that you had a 15% move, but then it came back down for a couple months, was still bottoming. And what happened? Well, it made a false new low in January, and then the gold stocks went up 60% in the next 4 weeks, right? So that's, aside from that, it basically tells us definitively that the recent low in gold stocks is definitely in, knock on wood. Yeah, so I look at those two charts and I think they make the case that the bottom is in. And in my past videos, I don't have sentiment charts, but there are, perhaps I can add them in post-production, but there's a lot of strong sentiment indicators that support this. I mean, Chinese demand is sentiment when you think about it, right? And let's get into that, because you have some great charts regarding Chinese buying. Where is that? That's I think this is it. Is that it? Yeah. Okay. So I'm going to put a couple. Do you see these charts? Yes, I see those too. I want to make sure. All right. So I want to put a couple of charts up. One of the main reasons that this is a bottom, or the bottom, is because China has been buying. Now, how do we know China has been buying? It's a nice story to have, but how do we know China has been buying? Because of these two charts. Now, there are two charts on your screen. The chart on the left is the People's Bank of China buying. And you could see that the lower the price is, the more they buy. Let me just pull up a drawing to... I love that chart on the left, by the way. Right. So this is with gold at 4,000. Now, it's tough to see the dates because it's not, and see if I can make it a little bit bigger. That helps a little bit. All right, so here we are looking at all this buying. This is, in case you're wondering, this is February of 26. See this area here, this is gold rallying. See this area here, this is gold dropping, and so China buys a dip. And you smartly pointed out that each one of these spikes in demand has been coinciding with a low in the gold price, right? And yes, because think about it. If we're just going back the last 3 or 4 years or so, off the top of my head, what are the most important lows in the market? Well, first you have October of 22, October 22, and then October of 23, and October 22, or maybe it was September 23. It's very similar. So what this chart shows, Vince, is the The two steepest readings on the chart, the most aggressive or largest PBOC buying, those coincided with the most significant lows in gold in the last 3 years. I'm being presumptuous, but what's the next significant low? Well, we had right now, or in the last month, and that is basically the third spike on this chart. And it looks like the data might be slightly delayed by a month or so. I can't tell if June was the last reading or if that's actually July data. This is April, May, June. That's July. 20 tons, 19. Very important to mention that because that's actually the low. That's going to be the low. So, and even that fourth little spike there in December 2024, that was a bottom in the market at the very end of 2024. That was also bottom. Not as significant as the other 3 points, but it lines. I didn't even know about this chart, but I did have the thought, but I might have said something to someone a couple of weeks ago, like there's all variations of this chart out there. Charts are us, has some versions of it. This is a very simplistic Goldman chart, but what you'll see is that as gold rallies, China's demand decreases. As gold rallies, China's demand decreases. As gold drops, China's demand increases. As gold drops, China's demand increases. China's demand increases. I mean, look, this is no buying. And then in 22, they unleashed hell. They just kept buying as much as they could. Between August and October of 22, they just bought all they could. And that was pretty much the bottom. That was when the US was raising interest rates and stopped raising interest rates in October of 22. And then that was the bottom. So that's that chart. The other chart is even simpler and more obvious, but not less important significantly. This chart is a chart of gold being purchased by other entities through London's OTC market. So this would be essentially London exports to China minus the PBOC official. So this is all the extra gold that they're not buying and not declaring. They're not declaring 900 tons over the last 5 years. Now, where is that gold going? Well, they're not hiding it. Well, they are hiding it. They're basically buying. They're a communist country, so they're authoritarian country. So they're buying it through proxies and through entities that are holding it for them, like Changong and Zhaoin and what have you, and the army. So this is gold being bought by China, being held not by their central bank. And this is bigger than this. This is the tip of the spear. This is the actual spear that they're buying. So that's it. That's the physical proof. That's the statistical proof that China's demand is the reason that the market bottoms. I mean, it cannot be overstated how important this is, that our observation that China, let me see if I can put an arrow up here. China buys as the market's dropping. China buys as the market's dropping. China buys as the market's dropping. And China buys as the market's dropping. And when the market rallies, they stop buying. They're stackers. They're not short-term traders. Anyway, can I add one comment to that? Sure. Okay, we don't see it in 2018. But aside from this, when was the most significant bottom? If we're going back 2018, that was the most significant bottom before 2022 was 2018. Now, you can't see that now. 2018, I think, if I recall correctly, I think that's when China suddenly really started to buy a ton. Pun intended. I think you're looking at their yearly buying, right? I'm just going off memory. Suddenly 2018 had this huge spike, and it's strong since then. I remember what happened I remember enough to fill this in. If you're looking at the chart of Chinese buying ramped up between 2016 and 2020, and then in 2020 it fell off a cliff because of COVID, and then through 2020 and 2021 there was no buying, and then they ramped up again in October of 22. So yeah, the Chinese buying in this area here before 2020 was up. Yes, I do remember that. If we had a chart handy, we'd show that. Okay, yeah, I'll throw something up in post-production. Yeah, sure. And again, this chart on the right here is also significant. Now, if that's not enough, but there's more, Jordan, there's more. Like Billy Mays. right? Exactly. Now, all right. So this is a chart of Chinese non-monetary imports less total reported central bank. So what are non-monetary imports? Non-monetary imports are imported gold that doesn't go through the bank or isn't bought out of London. So essentially that's ETF buying, that's retail buying, that's private investment buying, and that has been almost off the charts for them recently. In fact, this is insurance company buying. Insurance companies are buying gold in China as part of their insurance products now. So when you factor in the PBOC, which is the official flagship buying with the OTC, which is that London buying that I showed you with this Chinese government owns gold through its people concept, well, China's been buying a lot more gold than people know. And that's because they're setting up for gold to come out of the closet, so to speak, and become an HQLA or repo asset. Gold's going to be competing directly with treasuries in this Hong Kong venture that they're talking about. Let me stop sharing. All right. So that's China. That's the biggest catalyst. Oh, the other one is, I guess I should move to the other cat. I was waiting for your transition, or I wasn't sure if I should cut in with a transition. I didn't have a transition, but let me just do it now. So one of a good question to ask is, what was the reason for the sell-off? And there are several reasons, one of which is, though, the war was bearish for gold because they have to liquidate gold to get dollars. And that's frankly horseshit, except for Turkey. Everyone else was buying gold during this. So gold's not the risk anymore. In fact, Turkey sold a lot of gold. They sold more treasuries. So they needed dollars. They didn't care that the dollars were locked up in gold. They just needed dollars. But a legitimate reason for gold to sell off is because once the bigger players sniffed out that Walsh was going to come in very hawkish, they started to sell gold, and they said he's going to be a hawk on inflation. He's going to raise rates. Let's get out of our gold. And they started to do that. Now, in combination with the war, or the perception of the war over the last 4 or 5 months, people have been waiting for AI to destroy the employment situation. And so far, it hasn't. For whatever reason, it hasn't. No hire, no fire. I believe that's a mandate by the government to get corporations to toe the line. But what do I know? So as long as AI wasn't killing employment, then they could stay focused on inflation. Now, this last employment number came out and it was substandard. So now people are looking at Wash and they're saying, well, you know what? Maybe he's not going to hike. Maybe the data says that we should be long gold. And lo and behold, you started to see bonds. Remember, bond yields were climbing. We'll talk about bonds as well. I know you want to talk about that. Bond yields started to climb and gold started to climb with it. So I think what we're looking at here is a perception by the world, or at least by the Western world, that ETF buyer types, that Wash has gone from being a hawk to being a hawk who doesn't have to raise rates anymore. A hawk who would have raised rates to a hawk who doesn't have to raise rates because the market has done his job for him. And if the war ends, then the price of oil should subside. So that's the other catalyst, the Western perception that there'll be. And I said this to my subscribers, and I'll say it again here in 2022, between April and October of 2022, when gold had an 8-month slide, that was when we were raising rates. So for the last 4 months, gold has slid under the threat of raising rates. Now, if those raised rates don't materialize, then it could be off to the races again for gold, right? You wanted to ask about bond yields or bond rates. That was something you wanted to talk about. Yeah, so, okay, you're talking about the front end of the curve, but the back end, there's all this pressure on long-term bond yields. The third year broke out highest level since 2007. The 10-year yield is pretty close to that. I guess I have multiple questions. I'll just throw them all at you, and maybe you can answer them all just at the same time. At what point do they have to do yield curve control? I know there's probably some intervention going on right now. You know that they're in the market trying to hammer those long-term bond yields and keep them from getting out of control, right? H, how do you see this upward pressure on bond yields? Can that continue? And what is the Fed doing right now? Are they going to have to implement yield curve control at some point? Those are all the things I'm thinking about in my head in the question. see if you could address that as best as you can. So the long term, one of the things that WS claims that he's a proponent of is that in letting the long term rates set themselves. So if they want to climb, they'll climb. And he doesn't mind that because he thinks that'll keep inflation in check. If you get a higher interest rate for your bonds, then you'll buy a bond and that'll slow the economy down. And that's a nice plan. And that is a plan steeped in economics. And the economics of it is there are two ways to fight inflation. You can either raise the short-term rates, which we just described, or you could let the long-term rates go up. Now, it would seem that Walsh is conveying or projecting that he doesn't mind or that he wants long-term rates to go up, but you and I both know there's only so much of that he can tolerate. And the proof was in the pudding last week when the US intervened to defend the yen. So the quick concept behind how the Japanese problem is the American problem goes like this. Japan's yen is too weak for whatever reason, and in order to strengthen the yen, they have to buy the yen, and in order to strengthen the yen, they have to sell something to buy the yen. And what are they going to sell? US treasuries. So they sell US treasuries, take the dollars, convert them to yen, and buy yen. Now, they had been doing that, and that's been one of the reasons that the yield curve has been rising to begin with. But the yen got so destroyed over the last, say, several months that they said that they had to do more. And then, lo and behold, Scott Bessent steps in and he says, we're going to buy yen for you so you don't have to. Now, the cynical part of me, and I think anybody who's paying attention to this closely knows that if Japan's going to buy yen and they're going to sell treasuries to do it, we don't like that. So us buying yen would be a way of saying to Japan, you don't have to sell your treasuries, we'll just buy the yen for you. But we're going to do it by printing more dollars. We're going to print dollars and buy yen with it. So what we're doing is we're doing a type of yield curve control, or it's not yield curve control officially. I know that that's a boogeyman phrase, and I want to address that for a minute. But the yield curve control concept basically is where a government keeps long-term rates artificially suppressed in an attempt to give the impression that there is no inflationary problem and to persuade people to put their money or keep their money in stocks. And that's something that Japan have been doing for a long time now for the US to do, to overt Eli, say we're doing yield curve control is a disaster. It's like a naked emperor. I don't think we'll ever actually say we're going to do yield curve control. We'll just do everything else that seems like a mini yield curve control. And a mini yield curve control is when Scott Bessent says to Japan, don't sell your treasuries, we'll get your yen for you and we'll buy it. And we'll do that by printing dollars. So basically, you're increasing the monetary supply, you're doing dollar swaps. So we're increasing M2, all that to keep treasuries are more important than the dollar to the government. Treasury yields below 5.5, whatever percent that we have to keep them below. So there is to answer your question directly now, is there a level at which yields can climb to that will make the government step in and do literal yield curve control? Yes, but I think we have a lot of other things that we'll do before we get there. But the problem in Japan, I think, kind of showed our hands, and so it is a problem. And if Wash, I almost said Pell, if Wash is happy or not happy, if Wash is content with letting long-term yields rise in this environment and competing with stocks, well, then gold's going to rise with them now. So that's pretty much it. That's the yield curve control story. So to me, it sounds really bullish for gold. We have this upward pressure on long-term yields, and the curve is steepening because the market, as far as the 2-year and short-term rates, they know that it really can't move that much higher. I mean, Fed wore their job owning all the banks still. Some of them still think there might be a hike, but the smart ones have figured it out. The market discounting tighter policy on the front end, that's basically run its course. Right, exactly. And that's exactly it. When Bessent says he's going to print dollars, he didn't say that literally, but that's what he's going to do. He's going to print dollars to buy yen. That's what he's saying. There's no way we're going to raise rates on the short end. Now, to be fair, climbing long-term yields, if rates were to go from 5% to 10% tomorrow, that would be bearish for gold. It'll be bearish for stocks, bearish for everything, because a knee-jerk higher in long-term yields is bearish for everything else, because everyone will just put their money into bonds, which is kind of secular rotation. Real yields just spike through the roof like you had in 2008, like temporarily before it comes back down. Right. Right, exactly. But a slow creeping yield curve with the yields going higher, slow and creeping, is bullish for gold, in my opinion, because it says that we really haven't found the no matter which way bonds, I mean, this is going to sound aggressive, but no matter which way bonds go, as long as it's slow now, gold will go higher. That's how I look at it. Gold will go higher with stocks if bond yields come in. Gold will go higher without stocks if bond yields blow out in a slow, orderly fashion. So that's an opinion that I have, and I have a position to that effect. I am sure bonds right now and long silver. And I just last follow-up at some point. I mean, we don't necessarily know the level, but at some point that's going to be bearish for the stock market and the economy, right? I mean, that's what happened in '08. That, to your point, that is what happened in '08. In '08, you had an amalgamation of things happening. One was higher oil prices, which we don't have right now, not at that level. They were like $140 for a short period of time there. Higher oil prices, higher stocks, and higher yields. And yields kept climbing and climbing and climbing in '07, '08 until they spiked. And then the real, as you said, real rates spiked and stocks crapped out and gold crapped out. So eventually long-term yields have to have an effect on the stock market. But it seems that we're nowhere near that yet, because unemployment is still doing fine. People aren't getting fired yet. There's no slowdown. There's no slowdown in the economy, at least not yet. Well, because it's driven by government spending, right? And so as long as the bond market doesn't completely, I mean, as long as the bond market doesn't get to that level where the government is like, okay, now we actually have to stop spending or cut spending a bit, right? Then the economy can at least hold up. And that's something for the real serious fundamentalists or the real serious fiscal conservatives, and that is that all these things we're talking about, yield curve control, dollar lines and swapping and interest rates, all those things are treating the symptom. The disease is too much spending. And until we literally address the disease, which is down the road when we have to have fiscal austerity forced upon us, then until that happens, we'll continue to treat the symptom and have it's kind of like being eaten by a snake. The python is like around our chest right now, and about painful process. Right, exactly. So we keep treating, and that's what financial repression is all about. So I agree with you. For lack of a transition to an ending, I think we covered everything. You want to look at a chart for gold prices as well? Sure, yeah, you could. We could finish on that. Yeah, bring that up. Let me find that. I think that's this one. Is that right? Yeah, that's right. All right. What should we be looking at here? What kind of levels do you have? Well, one comment I want to make, I haven't mentioned this, and I think I haven't seen anybody else mention this, but if you zoom in on the summer, can you see there's a very small inverse head and shoulders? Do you see that? You can see the three bottoms in gold, right? Yeah. You mean, wait, hold on. Let me get my drawing tool here. You mean 1, 2, 3, and then do the fourth one. Oh, sorry. So you want to go 1, 1, 2, 2, 3, 3. Yeah. So here's your head shoulder. And so that I was looking at this last night, I think 4170 down to 39. So roughly speaking, this could possibly get to 40. Would that be 4400? I think we're basically already there. But actually, here's something that's interesting, Vince. I don't know if this is going to play out, but go to what you drew first, the first circle. Let me get my drawing tool out again. Whoops. Sorry, that's one of those trend lines that didn't pan out. The two big candles right there. If you circle that now, we've probably gone too far, but like if we made another shoulder here, like if you just look at the next couple days, like if we were to come down to 4200, right? And you would have an even bigger head and shoulders bottom. I don't follow you. Okay, well that's a shoulder. This would be a shoulder. That would be a shoulder. And then go to where we peaked, the last couple of days. Now, if that comes down to, let's say 4200, if that comes down to 4200 and then rebounds, you see that would be another shoulder. Now, the head there, Oh, I see. Right. It's like shoulder. Yeah. Shoulder and the head, that as far as the head, that would be called a complex inverse head and shoulders bottom, right? And you do see this sometimes in shoulder patterns where there's heads and shoulders like all over the place, but I don't think that's going to play out. But it was something I was thinking about a couple days ago. Right. I guess it's honestly, it's still possible. Like if we pull back right now to 4,200, well, isn't the complex head and shoulders consistent with this as a rounding bottom? Yes, you're right. Yeah, they look very similar, right? Like, and I think on silver you can actually pull up silver. I think silver has the same formation. Let me get it. And I think in spot silver, the measured upside target that we said for gold, 4,400, I think it's 68 in silver, but I have to, it's funny, that's my target here. I'll pull up silver and you'll see where my dotted line is. There's silver is more obvious to me, right? I mean, except that. So here's your shoulder, head, shoulder. Yeah, break the neckline and that dotted line. That's my target. I did a measured move from here to here. I said here to here and I added it and I said there's my measured move. So 68 is my level. Yeah, my neckline's probably a little smaller than that because I'm connecting there and there, right? To the right there. You mean, well, when you draw the knee, you draw the neckline. Yeah. But I'm drawing like a trend line lower. So it's connecting, what day is that? Like it's connecting July 22nd, that peak. So you're connecting, so you're connecting in here. Yeah. Like I'm connecting like that. I take the midpoint from there and then the one you drew earlier. Okay. I'm drawing like a down. Here's my line, there's your line, and you're saying I'm taking the compromising and picking this line. Yeah, because of the trend. No. See if you can draw a trend line from the July 6th peak. So the July 6th peak down to there or there. Yeah, that trend line. Yeah. So that's how I got it. Oh, I see. So it's like a slanted head and shoulder. Yeah. Right. A bent, a twisted neckline. Yeah, I see it. But regardless, we both came up with 68. Yeah. Either way, 68's a strong target. Okay, great. And so we're not there yet. And so even today, there's some pretty violent gaps in precious metals miners. So that to me is something to watch in the next week or two. Go ahead. I'm sorry. I still think we're going to fill these gaps, but given the chart that we showed earlier about how you have this big 1 week move and it's bullish in the context, I mean, who knows? That's why gaps drive me crazy, right? And you get a lot in precious metals because gold, silver, 24-hour trading, they're gapping all over the place. Yep, right, exactly. Gold and silver trade 24 hours a day, but the miners don't. So you have nothing but gaps on your domestic charts, that's right. Mm-hmm. Yeah. Well, that's great. Let me stop sharing. Cool. I think we covered a lot. Yeah. So any final words before we turn this off? No? Just well wishes and happy to be here as usual. And if people want to find me, they can find me on Goldfix, DBL Goldfix on Substack. And we welcome subscribers. After you subscribe to the Daily Gold, subscribe to Goldfix. All right. Thank you. Yeah, I was going to. You make my work easier. I don't have to give the pitch, but I will give the pitch anyway. Look, ladies and gentlemen, if you want to be better informed on gold and silver and everything that's happening in the market, daily updates covering everything that's important, you got to sign up for Goldfix. So VBL Goldfix search. What is it? Should they search for on Substack? VBL is just gold. VBL Victor Boy Larry Goldfix on Substack, or they can just type in Goldfix online and we'll come up as the first one. All right, so subscribe to Goldfix, everyone, if you want to be better informed on the gold market, silver market, and other markets as well, assuming that you've subscribed to Daily Gold first. But yes, please do. Thank you, Jordan. All right, great work, Vince. And hey, maybe we'll do this again in September. Maybe we'll have a good reason too.